Okay, so I'm going to try and talk as little as possible and just ask you questions. So I'll start broad, and I hope you take, it doesn't matter to me what you say. I just want, you're one of the people that I hope more people listen to. So I'm hoping to take what you say and share it with people. To that end,
likewise,
feel free to go in any rabbit hole you want. Yeah, so I'll start with a very broad question. What ways do you see, what significant ways do you see leveraging the financial system and the people within it to help speed the end of industrial animal agriculture?
I think I'm biased based on my experience and perspective, how my perspective has been shaped, but I do think that alternative proteins are a necessary but not sufficient means to end industrialized animal agriculture. I also think that similar technology-driven, free market-driven solutions like better forms of pesticides, for example, are similarly really important interventions in areas like wild animal suffering. So all of my answers are sort of going to be colored by that perspective or driven by that that mindset. But when I think about like what finance can do for animals beyond just divesting from animal protein producers and shifting capital away, increasing the cost of capital for those companies, I do think that mobilizing investment for alternative proteins is an extremely high impact intervention, especially if we can do that in a way that utilizes the most efficient and effective financial vehicles and instruments, borrowing mechanisms as much as possible from other sectors like climate finance or development finance, using things like structured finance, blended finance, renewable energy investment vehicles, and allocating that money to things with a view towards scale and impact and tractability and collectedness. So that's how I think about the value of finance and capital and investment when it comes to reducing animal suffering.
Can you expand on alt protein being a necessary but not sufficient? Yeah, what do you mean by that?
What I mean is that in a world where alternative proteins are economically dominant, I think that would significantly reduce but not eliminate industrialized animal agriculture, or even just less industrial forms of animal agriculture would still be there. So that's why I think alternative proteins are they're inescapably important. I think we do have to have alternatives to offer to people if we're going to get them to abolish the practice of farming animals. However, alternative proteins, there have to be reasons for why people make the switch. There have to be other things that help accelerate that transition if it's going to happen at scale and with speed. And I think that all other forms of animal activism, and there are a number of course, like effective forms of animal advocacy. All other effective forms of animal advocacy are accelerators for alternative proteins, and vice versa. I think alternative proteins growing enable more and more people to open themselves up to explore the cognitive dissonance created by consuming and using animals. And so in my mind, they're it's all very synergistic.
Definitely. Okay, so talk to me a bit more about mobilizing investment in alternative protein. What are the, let's talk about the next 3 years. Where are the lowest hanging fruit? or
Well,
the not necessarily lowest hanging, but highest payoff? Where do you, what do you hope happens?
what is probably like maintaining growth of early stage investment, as the entire global financial system goes through sort of a correction or some just different macroeconomic headwinds that are creating a difficult investment environment, even for VC early stage companies. Thinking beyond sort of the immediate circumstances we find ourselves in, there is a real need to diversify the types of funding that are available to alternative protein companies. And the reason for that is that at root, fundamentally, we're trying to realign food and agriculture. We're not trying to realign the software sector. And since we're working with atoms and not bits, we need a lot of infrastructure in order to do that. There's just no way around the fact that food and agriculture are very infrastructure intensive industries with high CapEx needs. Food, all the biomass we move for agriculture and food, it's probably moves more mass than any other human-made system, with the possible exception of like literal metal mining, and mining for energy. It is a tremendously logistically involved, enterprise to feed tens of billions of people and animals globally every day, or almost every day. So thinking about realigning that system, we're essentially engaging in planetary terraforming, and it just requires an enormous amount of capital in order to do that, to realign all of those supply chains. And a lot of so that's our like long-term vision. A lot of the intermediate steps that we need along the way are appropriate amounts of early stage investment for young companies, but we also need a lot more than that. Venture capital is really well suited for startups that are really focused on bringing to market new IP, commercializing new technologies, doing high risk, high reward type of research. But once you de-risk a technology enough to want to scale it up and start actually producing things with it and manufacturing in the real world, venture capital is generally ill-suited to that in the life cycle of a technology, that stage in the life cycle of a technology, because venture capital has, typically your average VC has very high return expectations, like 10x in 10 years. They have a very short return time frame of usually max 10 years. And they're typically really interested in things that have the ability to scale very, very quickly and very, very large, which is part of why software is the sort of killer application for venture capital investing. The problem is factories don't really meet those standards. They don't fall within VC mandates or the expectations that limited partners and VCs are going to have about returns. A factory is generally not going to be a 10x return in 10 years. It might pay for itself in 15 years or 20 years, or in some cases for certain types of infrastructure assets, like over a longer period of time. And then, fundamentally, you're just talking about so you're talking for one thing about a different type of risk profile. You're also talking about a different time frame for return on investment. You're also just talking about a wholly different category of the amount of funding that's required. So VC typically is going to get you, a $10 million check, a couple $20 million from large ones. You might be able to do a very large Series B, Series C round that nets you several $100 million, which is rare and generally only going to be accessible to really, really promising companies within any given sector. But
so
go ahead.
So let me ask, how, of all the things that need, you're mentioning infrastructure, do you think that maintaining early stage investments, like which is least, which needs the most attention? Not necessarily the most funding, but do you think that the alternative protein movement is at a point where active, like if someone's coming into the space and seeing what is lacking, what is the limiting agent, do you think, what like is it infrastructure? Do you think active
Mhm.
effort needs to be put into VC? Like if or do you think VC will sort of happen is at a point where it's happening? It's already, like you mentioned, it's good for the early stuff, but we're at a point where we need to scale. Yeah, where do you think the attention is needed?
Yeah, I mentioned the early stage stuff just because if you have it a very short-term time frame, it's useful, and it's more salient than it was. Like, 6 months ago, yeah, there was no part of the VC early stage funding pipeline that would have felt neglected. And now it isn't as neglected. It's infrastructure. It's just more important and more salient than it was. But yeah, there's no question. The infrastructure financing piece is way harder and way more important of a problem. And if you solve infrastructure, you've also necessarily solved the VC thing, because a lot of what drives VC is the ability to have exits. And a lot of that exit is going to come from later stage investors who are taking over the investment or participating in helping to scale up the hard infrastructure assets of early, previously early stage companies. So yeah, the infrastructure is absolutely the most like neglected, high impact side of things.
What is the tell me about bright spots. What is some of the most exciting, interesting work happening in infrastructure that we need more of?
So is it okay if those bright spots come from other sectors?
Yeah, definitely.
Okay, great. Because there aren't a ton of bright spots in alternative protein infrastructure. Um, so the one exception to that would be any company that can rely on an existing large established base of contract manufacturers is going to do better than one that has to build completely new infrastructure that's fully vertically integrated from start to finish. So the more you can outsource to existing contract manufacturers, the better. The problem is that a lot of the truly unique parts of alternative protein technologies, especially developing the initial texture and structure, particularly the macro structure of all protein and products, that tends to be fairly unique, and not a lot of people have the right equipment, the right expertise to do that right out of the gate. But once you get to sort of like for example, in the plant-based meat space, like a raw meat phase, there are a lot of further processors who are used to working with animal proteins who can make minor modifications to their process and their equipment in order to work with alternative proteins. And that's great because not only does that massively reduce the capital expenditure required, but it also literally competes for manufacturing capacity with animal proteins, thereby slightly increasing the cost. So that's like one bright spot area of like potential solutions, is that the more you can build your alternative protein technology to be able to utilize existing capacity, whether that's contract capacity or retrofitting facilities from some other sector, as long as there are a lot of those facilities available or just some facilities available, that really shortens your path to market and shortens your path to scaling and accelerates the ability you have to scale by lowering your capital costs and shortening the time frame it takes to build something. So that's a really important thing. And again, that can happen whether it's further processing for meat or for utilizing old bioethanol facilities, anything at all.
Okay, and then how about from other
Yeah. So I've done a lot of research on this question to try to understand what would be most helpful in terms of solving the infrastructure scaling problem. And I can talk more about why it's a problem, because I think it's important to understand like why it's such a challenging area. But I think the key solutions that are in bright spots the most exciting come from sectors that look a lot more like materials, like steel or energy production, like renewables, simply because those sectors have similar financial engineering challenges in that they're sectors that require high capital expenditure for manufacturing assets, but they have a low margin or commodity product that they're producing. In biopharma, which is often what alternative proteins are compared to, biopharma has very high capital expenditure, but they have a very high margin product. And so the J curve for that is a lot more shallow. You're able to recoup your investment a lot easier. The economics just pencil out a lot nicer than they do for a product that is literally designed to be a commodity and for which you're not going to get very high margins. So we have to look for inspiration to sectors like renewables in the energy space, or concrete, steel making, glass making, high capex, low margin product type of industries. And So when we look at those industries, the solutions that seem to be most promising include things like bond pass-throughs, so where larger companies essentially loan their credit rating, their low costs of capital to smaller companies generally as a form of impact investing. That is extremely important in that it counterfactually enables investment that otherwise would not have happened, and it also lowers the cost of that capital and enables an ideal capital structure, optimal capital structure for something like CapEx. The second thing, and this is probably the most important and useful tool in the sense that it's the closest you're going to get to a silver bullet, would be government loan guarantees for manufacturing facilities. So if you are, and there's a lot of examples of this like Tesla, a lot of examples from the renewable energy space, but if you're willing to, if the government is willing to put their full faith and credit behind an enterprise, that enables private sector lenders, especially bankers, to loan money against that asset, even if it's an unproven technology, even if it's the first time we've done this technology at the scale before, even if it's in a relatively new and unproven and immature sector, because they know that there's no downside. And so that again enables loans to happen that wouldn't happen otherwise at better rates and with better terms than counterfactually would have happened without the loan guarantee. The second thing that would make a massive difference is offtake platforms. So essentially demand guarantees or volume guarantees, or just they're often also called guaranteed minimums or advanced purchase commitments. There's a variety of names for the mechanism, but it all boils down to the same simple idea. And when you think about building infrastructure, there are a number of risks that are taken into consideration, whether it's equity investors funding it or investors. Those risks are things like input risk. What are your feedstocks? Do you rely on a source of sugar to feed your fermentation microbes that is hard to come by? If so, that's a risk. A second category of risk is regulatory risk. Do you have to get your facility approved or rely on, is the ingredient or product that you're producing, are there regulatory barriers or even regulatory complete stops? Like you just can't produce unless you have certain things approved or like a new regulatory framework in place, like for novel proteins or novel strains of microorganisms. That's really important, a really important risk category. The third category is operational risk. Like, is this a company that's able to operate a manufacturing asset well and effectively? The fourth category is technology risk. Will this technology perform at this scale in an economic way? And the fifth category, and the one that's most important to everybody who's looking at this, is demand risk. Is there an offtake? If I give you money to build this factory, will there be demand for what the factory makes? And that offtake has to be from somebody who's committed and who is sizable enough and has a good enough reputation that they're seen as a truly effective counterparty. So if you have 10 orders for your ingredient that your factory is going to produce, but they're all from small startups, that doesn't look as good to a bank as, or any other lender or an equity investor in a facility. If you have a very large committed purchase order from Nestle or a large food or large strategic corporate buyer who said, yes, we'll buy whatever, at this price, at this performance level, we will buy whatever your factory is producing. So that offtake arrangement is extremely important. And there is precedent for that coming from a few different places. Breakthrough Energy has a program called the Catalyst Program that combines capital and investment from the Gates Foundation as well as different companies to provide a guaranteed offtake for different types of high capex, low margin climate technology companies. So things like green hydrogen, for example. So that's a really cool program that's leveraging impact-oriented investors to try to provide that. A second example of advanced market commitments comes from the vaccine space. It's actually been used for decades, but a lot of people first heard about the concept with the COVID-19 vaccines, where governments committed in advance to purchase the vaccines, which allowed companies to de-risk financing to build all necessary infrastructure to produce the vaccines. So having that guaranteed purchase really helped. And then if you're just looking for like a purely private sector solution, there are examples where you can structure a financial product where essentially you guarantee a certain minimum amount of capacity utilization or a minimal amount of sales And then you can structure a financial product where investors buy or will essentially provide the money, and they're able to reap the upside, and the company itself is able to trade away a little bit of their future upside, in order to get access to that upfront investment. A good example of that might be like if you're making a cool ingredient, you might agree to a sweetheart deal to sell that ingredient. You might, as a company, think like, I can break even on this factory if I just sell it like 65% capacity. And so if you have a volume guarantee in place for 65%, you're going to be able to, your banker knows that they're going to get their money back. And then whoever sold you that guarantee will just make money on the delta between 65% utilization and whatever you end up utilizing it at, which hopefully is like 90% utilization. So there are private market ways of doing it. It's just that's kind of a more complex structured finance product, and it's rare.
Oh, this is all very, very exciting. That like it's exciting that these are the problems that the space is having. Yeah, I wish that the problems didn't exist, but we weren't anywhere near having these problems a decade ago. Can I ask, so how, wave a magic wand and who needs to be working on this? Like who is best suited to, who needs to be at the table? Like how do we get the types of people working on this that need to be working on this? Like who do you want on the team?
Yeah, can I add two more solutions though to the pile, since that also is relevant to the people question? Two other categories of solution. The first one is technology risk insurance as a bright spot from the climate tech space. So the best example here is, or case study is, New Energy Risk, which is a company that was a spinoff from a large insurance company, AXA, and they transfer technology risk for new infrastructure investments to the insurance markets. So what they do is they will come into the pilot at the very early stage of a new technology's development. Maybe a startup has a really cool new, green hydrogen solution, or nature, something else that just is good for climate tech. That's where they've had most of their experience. They are looking at alternative proteins right now, but they will look at they'll structure a pilot plant setup so that they can gather a lot of data about the performance of the technology at a pilot scale. And then they have a team of scientists and entrepreneurs who essentially use that data to then underwrite an insurance policy for a larger scale investment in manufacturing infrastructure. And that can be either debt or equity investing. And that insurance policy essentially guarantees a certain minimum level of technology performance, which is an amazingly powerful intervention. Yeah. Because if you're able to go to a lender or an investor and say, our technology is going to be guaranteed to perform at this level, that again eliminates an entire category of risk, takes it right off the table for those investors. And again, that means that lending and equity investments happen that counterfactually otherwise wouldn't have. They happen faster, and they happen with better terms and lower rates than would have happened otherwise. So that's an incredibly powerful intervention that, again, we can just copy and paste that model from other sectors and apply that to alternative proteins. The final category of intervention that I think is really high impact is investment research, data, and consulting platforms. And this is where I will note that I do have a bias in that is the startup that I am helping to launch, simply because they provide the rails, or sort of the interface between large scale institutional investors, high net worth individuals, sovereign wealth funds, all these different potential LPs or direct investors in alternative proteins. It provides the means and the access to those investments in a way that's well suited to supporting, analysts, augmenting the research teams within large asset managers or large institutional investors, providing the data to underwrite decisions like whether or not to lend to a particular facility infrastructure project, or just providing sort of, the third-party expert assurance that this is a good idea and that you can take to your investment committee when you're making allocation decisions. So that feels particularly important as a way to drive more capital, bring more capital into the alternative protein sector, but it also has the additional benefit that you're able to exercise a high degree of influence over where that capital goes. And ideally, of course, driving it to the most impactful, neglected, and tractable opportunities. And the sort of third category of impact that's related is that you're able to, much like GiveWell does in the charity evaluation space, you're able to not only direct money to where it needs to go, but you're able to help direct the recipients of money, in this case, fund managers or banks or alternative protein companies, to help them make themselves as appealing as possible to investors and future prospective investors, and to also catalyze new types of financial instruments like loan guarantees, like technology risk insurance, like well time-tranched construction and infrastructure investment funds. You're essentially able to help encourage the development, directly support the development of optimal financial vehicles and structures and mechanisms and products for alternative proteins. So there's sort of three different vectors of impact with that particular idea. So that's all the like major bright spots that emerged from the research that we've done over the past few years.
Okay, so tell me, you just talked about it, but tell me a little bit about the consultancy firm that you're starting, BERA.
Yeah. So BERA is intended to be the GiveWell of alternative protein investing. Other models that we're drawing inspiration from come from the climate space and from the development space, but essentially the idea is, it's very similar to something like BERA Partners in the hedge fund world, or New Energy Finance, a company that was acquired by Bloomberg a few years ago and has provided research data, insights, and advisory services to the institutional investor community for the renewable energy sector. When you look at the challenges that keep especially larger institutional investors from investing in a category like alternative proteins, there are sort of three big buckets of challenges. So the first one is that they're just straight up risks and deterrents that keep it outside of their mandates. The second is that there's a lot of often transaction costs. And the third is that there's a real lack of information and a lack of data. So to sort of unpack those a little bit more, when we think about risks and deterrents, a lot of the early stage, investing in an early category is just high risk. It doesn't fit into their asset class, categories, their time frame, their the return and risk mandates that they have as an investor. They often have to answer to a higher power. Like if you're a pension fund, you can't lose the money of the people that contribute money to your pension fund plan. And so there's a certain amount of risk they can take, and a lot of risks they just can't. And so something that's seen as too risky is out of bounds. There's a liquidity risk when you get into an investment in that if you need to sell it, you don't have access to a way to sell it. That's really challenging. There's a lot of uncertainty of how to do valuations. On the sort of like transactions cost side, a lot of times the deals that are available in a young sector like alternative proteins are just too small, or there's not enough deal flow to justify having somebody get involved and somebody pay attention to the sector. And then that sort of is compounded by the fact that you don't have as much experience in this area. So you have to build all your models from scratch. You don't have the right networks of people to talk to you about it. You don't have access to the right research or data for it. And there's a sort of a syndication risk here too, in that you have to go out and find co-investors, because most lenders, most equity investors, particularly for large scale investments, don't take 100% of that investment. They'll maybe lead the deal if they're large enough, but they will look to syndicate the deal and find co-investors to partner with to take the rest of the deal, so that they don't have this entire exposure to one company or one deal. So there's a challenge there when you're working in a new sector. And then in sort of the like lack of information side of things, you don't have a lot of like data on financial metrics or ESG metrics. You might not even be aware of this sector. It might just be too early for it to have crossed your radar. And then there's also sort of the competition element, in that alternative proteins are an incredibly powerful climate solution, public health solution, but there are a lot of other sectors that compete for the time and attention of investors. And those sectors are often things like crypto or fintech, or even things like renewables. that are more well established, much more well known, and it just alternative proteins isn't recognized as a solution or as a profitable opportunity. So think about there's a lot of challenges. Those are a lot of, and that's not even an exhaustive list. But what's exciting about all of those challenges categorically is that those are challenges that at one time or another, other sectors like biotech or sectors like renewables had to face. And so we know that there are ways to overcome them. And one of the reasons why the investment advisory and data and research approach is so powerful is because it addresses multiple of those things simultaneously. So it enables you to effectively assess risk, much more effectively assess risk, to measure and get access to data, to get access to models for valuation. So it saves you a lot of time. It augments your research capabilities so that you don't have to hire someone. It's really hard to justify hiring one analyst if you're only going to see 3 deals a year. But if somebody else can help you assess those 3 deals a year for less than the cost of an analyst, that can be much more appealing. It also helps you identify the right pooled vehicles and structures that make it worthwhile, even if the deals are too small. And it just sort of covers all of the sort of data and information flow issues that arise, with absent some intervention like this, because otherwise you have to try to navigate the space yourself and figure it out. And again, that's a question of time. Most of the investors that have the capability to really move the needle when it comes to an alternative protein infrastructure have way more money than they have time. The hardest part for most investors is getting money out the door fast enough. And so sorting through the noise, figuring out whether they should put money into this sector versus that sector, these are things they think about it at a very high level. And so making alternative proteins stand out in that noise means having to build plumbing, building the rails that enable investors to easily include this as a theme in their portfolio, making sure it exists as a theme that can be invested upon based on the existing solutions they already have in place. A lot of investors use outsourced chief investment officers or discretionary advisors, more often than not at places like large asset managers like BlackRock or Goldman Sachs or something. And so working with those groups to help this be an investable theme and integrating it as part of their food and agriculture portfolio, integrating as part of their ESG impact investing portfolio, climate change portfolio, public health, pandemic risk portfolio, that's where there's a lot of work to be done. And where something like this group, again, consciously patterned after groups like New Energy Finance, seem to have a particularly important role to play.
They do, and I'm so excited that BERA is happening. Okay, so we have a understanding of sort of what BERA would be doing. Who does it need to connect to? How? Yeah, a few follow-up questions. Let's start with that. Magic Wand, what are you looking for? Is it connections to, what are you looking for BERA? What do you hope people reach out to you for?
I actually think I would probably combine the answers for BERA as well as just in general what alternative proteins need, which is, a lot of the investment that's going to come in space is going to be intermediated by fund managers, and that's going to be a combination of specialist funds like Blue Horizon and Unovis, as well as more generalist funds. Perhaps they're infrastructure-focused funds, perhaps they specialize in manufacturing, perhaps they specialize in climate tech, but for whatever reason, they're a private equity, growth equity, or infrastructure debt fund that just really focuses on, has a potential play in this sector. Getting their attention is really important. So I'd say right now the alt protein specialist funds, great, they're already experts in this category. Getting generalist fund managers, infrastructure, PE, real estate, otherwise growth equity involved is extremely important. And so those are the types of groups that BERA needs to reach, and also just the industry in general needs to reach. The second category, though, is the folks who invest in funds. So finding potential LPs who can invest in some LPs, some asset owners, like Canadian pension funds, can invest directly in companies. And that's an important vector for getting more money in this space directly with no intermediaries involved. But only a handful of asset owners are large enough and sophisticated enough to be able to do those types of investments. And or like flexible enough. Family offices are probably an exception to that, where they have the ability to invest directly in companies often. But increasing the amount of direct investment is very useful because it helps companies get access to capital that they might not otherwise be able to get. But it's also really important to work with asset owners to get them into alternative protein funds. That could be alternative protein specialist funds, or it could just be food and agriculture funds or manufacturing funds that have a large alternative protein theme and focus, and maybe 10%, 15, 20% of their portfolio ends up becoming alternative protein assets. That's extremely important as well, because asset manager, or the fund managers, excuse me, are the real experts in finding companies, doing due diligence on them, and pooling those into vehicles that hopefully spread risk and create a really attractive investment opportunity for a lot of prospective limited partners, for LPs. That's the second category of things. Like, any asset owner is really important to talk to, particularly ones who are more interested in impact or ESG metrics, or who have an understanding of food and agriculture, and who therefore have more likelihood of investing in alternative proteins. The third category that is really powerful and important to work with are asset managers like BlackRock, like Goldman Sachs, that are managing investments on behalf of large asset owner clients. They're either an outsourced CIO or a discretionary advisor that's literally making investment decisions on behalf of their clients, or at the very least providing consulting services on behalf of clients. So groups like Mercer or Cambridge. And that's important because they represent a large amount. They represent a lot of volume in terms of investment. And this alternative proteins is often too small to attract their attention as a full category thing. But as part of it's important that they integrate it as a theme within existing areas of interest for their clients. Those themes could be things like food and agriculture. Alternative proteins should be a part of those portfolios, or those themes that a managed account can offer. Or maybe the theme is climate interventions, or pandemic risk interventions, or just generalized ESG impact investing themes. But including alternative proteins as part of the menu for those sort of like categories that investors are interested in is extremely important. And a group like BlackRock doing that, or Goldman Sachs, drives way more volume into this category than almost anything else.
Yeah, I mean, I'm excited. I'm excited that all of this is just work that needs to happen. It's not like an intractable. There's nothing magical or mysterious in between us and progress. So let's say someone's looking for what you want BERA to provide right now. What's the closest existing are we basically at ground zero? Would they be looking at GFI? Let's say BERA doesn't exist and you need the services that BERA is providing, or going to be increasingly providing. Who does anything exist like this?
Yeah. On the advisory and consulting side, sort of. There are players like BERA Partners that will do. This is one of the verticals that they serve, would be investors, and they're a specialist in all proteins. There are a number of independent consultants who would do various aspects of due diligencing and writing reports on a company or a fund. Although most of them, I imagine, would be more well suited to evaluating a company versus a fund manager. There are also you could cobble something together essentially for independent consultants. You could also just do this in-house. You could generate research in-house, but to do that, you of course have to pay an analyst, and that analyst has to figure it out, which is probably still going to involve some sort of external third party, because it's the rare analyst that can really figure out the regulatory concerns, the technology concerns, the financial and operational due diligence, all the things that are required when you're thinking about investing in a fund or a company or both. And then the other I guess like on the consulting side, there are non-specialist consultants. So you could absolutely hire a McKinsey or a Bain or an Accenture or BCG to do a scoping analysis of a fund or a company that's a potential acquisition target or an investment in a company. You're just going to pay for that. That's very expensive, and they're not specialists, they're generalists. So they would know a lot about, food and agriculture, for example, but they would know less about maybe the unique characteristics of alternative proteins. So they themselves would then go out to like networks like GLG or GuidePoint or something to supplement the knowledge that they don't have internally. Then on the data side, that's really challenging. So like, how do you get pricing data on the market, or understand like what's the total amount of manufacturing capacity in Canada for plant protein processing facilities, so that you can justify an investment case for building a new one? Well, that's really tough to find. Basically, in a lot of cases, nobody has that data, no one company or person. And in cases where it is aggregated, it's generally aggregated within large corporate players that are already in that space. And as such, it's very difficult to get if you're trying to justify building doing an investment that would directly compete with what that company is doing. So data on prices is very opaque, especially for things like ingredients. Data on existing capacity is very opaque and very closely held. And those are two very important data points to think about when you're thinking about making an equity investment or lending to something. So that's part of the need here, is that while there's an initial focus for BERA as a company on fund and company level research and due diligence, there's also going to be a similar level of focus on generating data, which again is something that was an incredibly valuable thing that New Energy Finance did early in their life cycle, was identifying, here are the data gaps, and then providing the data that's needed to do effective valuations to basically build good models for underwriting a loan or investing in a publicly traded company, or anything in between.
Lovely, thank you. Okay, so we're nearing the end, and one thing that comes to mind is that I don't need to interview anyone else. I can just do weekly calls with you. I feel like there's a book's worth right there. But let me ask. So we're going to be interviewing a handful of folks. Basically, there's no one we can't. We're pretty good at getting access to anyone we want to interview. So, two questions. One, who would you want to see interviewed for a book like this? And two, what questions do you want people like that to be considering? Like, imagine you go to the store, pick up a book, and be like, I want to know what blank thinks about blank. Tell me about blank and blank.
Yeah. I think it'd be really cool to interview someone who's helped like structure yield codes. So generally, often publicly traded vehicles that sort of are holding companies for large pools of, say, like renewable energy assets, and they fulfill an important function because they're a highly liquid investment that's structured like a utility with high dividends, and are really appealing to institutional investors. But they can essentially buy factories or hard assets from development companies, which are more like taking the short-term equity, mostly equity-driven risk of constructing new assets. So I think that's a really promising model to add to the list, but it's also something that it has scaled up as an intervention quite well. And talking to people who've done that would be really interesting.
Sorry,
anybody?
Say it again. People do yield codes?
Yep, it's called YieldCo. It's the YieldCo DevCo model. So YieldCo being like a pooled vehicle that's a long-term holding, and DevCo being like, say, renewable energy, like solar photovoltaic or hydroelectric or wind power developers. Because when they develop an asset, if it only pays for itself in like 20 years, they've got to sit around and wait for that asset to pay itself off before they can move on to the next project. Whereas if they can sell it, they're able to recycle their capital immediately. The early stage investors get paid off, then they can move on to the next project. So it's a way of recycling capital such that you can increase the pace of development. And then from the long-term holdings perspective, once an asset's built, it's generally, and you've got it operational, it's generally de-risked, right? There's demand, that the factory is going to work, that whatever you're producing, whether it's energy or ingredients, it's going to keep producing that, hopefully at fairly predictable rates that just go up over time, thanks to the magic of experience curves. And so that becomes a relatively safe asset, particularly when it's pooled. So that seems like a particularly important model to replicate in alternative proteins. And people who've worked on that, and indeed people who've worked in any of these solutions that I've mentioned, like loan guarantees or technology risk insurance, I think would be really interesting people to interview. And there are people who specialize in like climate finance vehicles. So Climate Policy Initiative has an excellent climate finance initiative called the Global Innovation Lab for Climate Finance. They'd be great to talk to. The Convergence.finance is a data and sort of network, data platform network for blended finance, which is the use of impact investment and or government public sector investment to blending it with private sector capital, more market rate capital, in a way that de-risks an investment for the market rate investors. So, for example, taking a concessional position, accepting lower terms or longer payoff, maturation on an investment in exchange for that, and providing less risk or better returns profiles for the market rate investors. So I think that's a really powerful whole category of interventions that applies to so many different areas. And people who work in blended finance would be excellent to interview for this. World Resources Institute has a climate finance group, research team.
And can I ask?
Yeah.
Do you think try and go one step? Not related to that question, or not directly related. I think the significance of individuals like yourself in this movement cannot be understated. Like you're doing something new, and we are you're working on the funding of infrastructure is the hard thing that is the important thing. And so how would you encourage more people to break new ground? Like you could have started a VC firm. You could have done what many others are doing, but you're doing something new, that a niche that is unfilled. So my question is, how important is it, do you think, and do you see any way to get more people like you filling niches that are effectively untapped? How do we get more people like you? How do we have more people pursue empty niches?
Yeah, well,
broadly.
I hope this book project helps. I mean, you said it yourself at the very beginning, and a lot of it's just talking about it more, publishing and writing about it more, and just trying to build a conversation around awareness of the need. Because the reality is, the people most well suited to this are people who have the desire and passion for alternative proteins or for climate or for animals or whatever, and are also have background experiences or connections that would be relevant to this. So people who work at asset managers, people who work at large investment banks, people who work at large private equity funds or infrastructure funds, people who just have that sort of expertise. And so I think reaching them is just a matter of, we need to be talking about it, writing more about it. That's one of the things I tend to do a lot more, just to try to, now that it feels like there's some possibilities here, we just need to write about it. You need to put your ideas out there so that people can say, no, that's not going to work, and here's why, or that might work if you change this approach, but also just hopefully inspiring action. So building community, I think, is really important. And I suspect the best way to do that is just the same ways you do anything: direct, asking for referrals, direct engagement with people who seem like they would have relevant expertise or knowledge or interests, going to events, speaking at conferences, really just trying to, as much as we can, get this on the radar of people in the investment community, food and agriculture investment, ESG, impact investing, generalized finance, the UN ecosystem, the nonprofit and academic ecosystem that exists around things like climate change interventions and climate change and ESG finance. That all seems really, really important. Engaging with all the different groups who are, very well connected in these spaces, like World Resources Institute, like the Climate Policy Initiative,